Well, we turn our focus now to the repo market. Our next guest says the risk of a U.S. downgrade or default could cause a liquidity freeze in repurchasing agreements. Well, George Goncalves is the head of U.S. rate strategy at Nomura Securities, and he joins us now to explain. And George, I have to say the repo market, I worked in fixed income markets for quite a while. The repo market is generally a small sort of, I don't want to call it a quiet market, but it's not one that many people really understand unless they're working in it. So maybe you could break down a little bit of what the repo market is.
Well, I wouldn't go as far as say it's small. I mean, you might get some repo.
I don't want to say it's small either.
You might get some repo traders up in arms, and they're a feisty bunch. I think the simplest thing, repo, is a trade where investors lend securities and they receive something in return. Most of it cash, and repo is highly used by money markets in the U.S., especially in lieu of the fact that money markets don't have the same accessibility as banks do to the Fed's window and the Fed's excess reserves and paying interest on reserves. So, I mean, repo is very critical. It's the plumbing of the financial system. It's the plumbing of the primary dealers. And it really is what keeps everything fluid.
Yes, and it's one that typically we don't see in the headlines. We may hear about junk debt. That was more my point than to say it was small. And here I'm going to highlight what I mean by this, because there was an interesting interview with Mohamed El Arian just yesterday. He was on Tom Keene's show, and I want to bring this up because he made a point that I don't know that I've ever heard before. He said, that's the very first thing I do now is I go over to our money market desk and ask them, what are you seeing today? How's the repo market operating? So explain this in the context of this debt debate. What happens to the repo market? What's more damaging, a default or a downgrade, or both?
You need to make a clear distinction between default and downgrade. A downgrade, we can go over what that means for the broader markets, and for the repo markets, really not much. A default obviously creates a lot of turmoil. So, just to be very clear, our view is that we don't believe default is imminent. We don't think that there's going to be any sort of these kind of scenarios unfolding. But that's something that I think markets should be clued into and should be aware of what are the risks, because it comes from a market, like you said, that it's little known by the rest of the street.
So let me ask you this. Treasuries are often posted as collateral in the repurchase market. Will there, if there is a downgrade of U.S. debt, will there be an immediate impact on that collateral, on treasuries being used as collateral? I know that there are things called haircuts that are assigned by DTCC that clears these trades.
That's right.
They assign a haircut to the collateral. Will they assign a bigger haircut to treasuries as collateral? Is that an automatic mechanism that happens in the event of a downgrade?
It's not necessarily, and I think we need to see how the rules are defined if the downgrade takes place. But it will create frictions, and I think markets will themselves introduce a higher cost of funding just because of that unknown. So look, let's take a step back and ask, is a downgrade also imminent? I mean, I think that people have now taken it as a foregone conclusion that the downgrade has to happen. To me, it's not clear. I think that the S&P potentially has boxed itself into a corner in expecting that you need to have all this criteria unless we're going to downgrade the U.S. I think there's a graceful way around not seeing a downgrade take place, even if you don't get a full $3 trillion package. So I think let's not jump the gun and think that downgrades are imminent, that default's going to happen. A lot of this is pomp and circumstance. The political theater that we've gone through has now been taken to a whole new level. But I don't think we should price in 100% certainty of a downgrade.
Okay. George, good to have you in the studio. Thanks for keeping me company. We've had a busy day. You can see just in the hour, a lot going on. Let's go back to the question of default and when that happens and that August 2nd deadline. How critical is that day?
Look, I assign at least a 50% probability that we reach August 2nd and there's nothing done, and it still would not be considered a default. August 2nd is a self-imposed deadline. Of course, the administration yesterday said there's no off-ramps. There are off-ramps. There are ways around it. I think just not highlighting them now is just so that we can get the process pushed forward and we don't drag it out beyond August 2nd, but they could work around it.
There will be the issue, though, of making payments, right? So there are Treasury bills, right, the borrowings that will be coming due that they have to pay back for, weak Treasury bills that will be due at some point there. Let's go over some of that timeline. When is money actually expected to be paid, and what payments can be missed that don't qualify as default?
As long as, in my opinion, and I think this is also the view of ISDA, is that as long as interest and principal continues to get paid, you're not technically in default. So as long as you're paying your bonds that mature and you're paying the interest on that, you're not in default. What could happen, in the worst case scenario, this is again not our view, is that you start to shut down the government on August 3rd, 4th, 5th, until there's an actual resolution, so that you're not bleeding cash, because there is enough cash to get us through at least August 9th, August 10th.
All right, we have enough cash for those days, and I just want to go back. ISDA is the International Swaps Dealer Association. They govern the contracts that are written in the credit default swaps market. So from their perspective, they're looking at default, as you pointed out, they have a very specific definition for default. So if it is default by ISDA standards, what impact does that have on the credit markets?
Even then, there's a grace period. So I think if any of these things were to transpire, you better believe that Congress would get itself in gear and we would have a package in place. I don't think it has to come down to that level. And I think that what we're seeing today and into tomorrow, eventually we'll get a compromise bill over the weekend and into next week, and we'll see either that get put into law, and even if it's not finally all marked up, it still would not consider it to be a default, and it would just get us through this period.
George, quickly, there have been a lot of different economists out talking about what a major catastrophe this would be for the U.S. economy should we have a downgrade or default. What is your perspective on that?
Well, downgrade is one thing, default's another. So make sure your viewers are conscious of the fact that there's a difference between the two. Default is you just don't know what kind of can of worms that's going to open up. Downgrade, I think, even if it led to, in our view of our economists, even if it led to a 10% correction in the stock market, 50 basis point move in 10-year treasuries, it still would only take about 0.5% of GDP. The critical question is we're entering into a period in the second half of the year where the data is soft, so we really can't afford to add this further uncertainty and to take away growth at a time where it's pretty unstable. So let's not get there. Let's make sure that we, at worst case scenario, I could see the downgrade, but even that I'm assigning a low probability still at this point.
All right, George, appreciate your insight. Thanks for joining us. It's a lot to get your arms around. That was George Goncalves of Nomura giving us a look at how a potential downgrade and a default might ripple through the rest of the market.